Alright, picture this. You're scrolling through your bank app. Maybe you're checking your balance, planning a purchase, or just generally trying to figure out where your money went. You see a number, a total. But what exactly is that number? What's included? Is it everything you own? Or just a slice of the pie? And more importantly, does it include that checking account you use every single day? That's the question we're diving into today. Does M1 include checking deposits? You've probably heard the term M1 floating around, maybe in a finance class, a news article, or a casual conversation. But what does it actually mean, and why should you care? Let's break it down. Money. It's the lifeblood of our economy, the fuel that keeps the wheels turning. But money isn't just a pile of cash under your mattress. It's a complex system, a network of different forms, all working together. To understand how it works, economists and policymakers use different measures, called monetary aggregates. Think of them as different ways to count the money in circulation. M1 is one of these measures. It's considered the most liquid form of money, the stuff that's readily available for spending. And that's where the checking account comes in. To really get to the heart of this, we need to understand what M1 actually includes. Traditionally, M1 is defined as currency in circulation. This is the physical cash, the bills and coins in your wallet, your purse, your piggy bank. Checkable deposits. This is where things get interesting. Checkable deposits are balances held in accounts that allow you to write checks or use debit cards to make payments. This includes those checking accounts we mentioned earlier. So, the answer is yes, checking deposits are a core component of M1. But it's not quite that simple. The financial landscape is constantly evolving. With the rise of online banking, mobile payment apps, and other digital innovations, the way we use and interact with money has changed dramatically. This has led to some debate about the definition of M1 and whether it accurately reflects the money supply in today's economy. For example, what about those online savings accounts that allow you to transfer funds instantly? Are they as liquid as a traditional checking account? What about those peer-to-peer payment apps? Do they count? These are important questions that economists and policymakers are grappling with. And the answers can have significant implications for things like interest rates, inflation, and economic growth. Think about it. When the Federal Reserve, or any central bank, is trying to manage the economy, they need to have a clear picture of how much money is in circulation. If they underestimate the amount of money available, they might tighten monetary policy too much, leading to a slowdown in economic activity. If they overestimate, they might loosen monetary policy too much, leading to inflation. That's why understanding M1 and its components is so important. It's not just an academic exercise. It's a crucial tool for understanding how the economy works and how it's being managed. Now, let's dive deeper into the specifics of checking deposits and their role in M1. Checking accounts are a fundamental part of our financial lives. They provide a safe and convenient way to store and manage our money. We use them to pay bills, make purchases, and receive income. They're the backbone of our day-to-day financial transactions. But checking accounts aren't all created equal. There are different types of checking accounts, each with its own features and benefits. Some accounts offer interest, while others don't. Some accounts have minimum balance requirements, while others don't. Some accounts offer overdraft protection, while others don't. Regardless of the specific features, all checking accounts share one common characteristic: they allow you to access your funds quickly and easily. This is what makes them so liquid and why they're included in M1. The liquidity of checking deposits is further enhanced by the widespread use of debit cards and online banking. Debit cards allow you to make purchases directly from your checking account, while online banking allows you to transfer funds, pay bills, and monitor your account balance from anywhere with an internet connection. These technologies have made it easier than ever to access and use your checking deposits, further solidifying their role as a core component of M1. However, the rapid evolution of financial technology has also blurred the lines between different types of accounts. For example, some online savings accounts now offer features that make them almost indistinguishable from checking accounts. They allow you to transfer funds instantly, pay bills, and even write checks. This has led to some debate about whether these types of accounts should be included in M1. Some economists argue that they're just as liquid as traditional checking accounts and should be included. Others argue that they're fundamentally different and should be excluded. The debate over the definition of M1 is likely to continue as financial technology continues to evolve. But one thing is clear: checking deposits, in their traditional form, remain a core component of M1. And while we're talking about M1, it's worth mentioning the other monetary aggregates, M2 and M3. M2 includes everything in M1, plus savings accounts, money market accounts, and other less liquid assets. M3, which is no longer officially tracked by the Federal Reserve, included everything in M2, plus large time deposits and other even less liquid assets. These broader measures of the money supply provide a more comprehensive picture of the financial landscape. They're used by economists and policymakers to assess the overall health of the economy and to make decisions about monetary policy. But M1 remains a crucial indicator of the most liquid forms of money and the overall level of economic activity. It's a measure of the money that's readily available for spending, the fuel that drives the economy. So, to circle back to our original question, yes, checking deposits are a key component of M1. They represent the most liquid form of money, the funds that are readily available for spending. Understanding M1 and its components is essential for understanding how the economy works and how it's being managed. It's a crucial tool for economists, policymakers, and anyone who wants to make informed financial decisions. The financial world is constantly changing. New technologies, new products, and new regulations are constantly emerging. But the fundamental principles of money and banking remain the same. And understanding these principles is the key to navigating the complex world of finance. With that said, thanks for watching, and until next time.